Welcome to the B.F. Anderson Technical Report for April the 8th. Peter Lynch, the Fidelity Magellan Fund, a very famous fund. He wrote a book called One Up on Wall Street, and I can remember he had a chapter in the book called The Weekend Worrier. In other words, he says there is always something to worry about. Avoid weekend thinking and ignoring the latest dire predictions of the newscasters. Sell a stock because the company's fundamentals deteriorate, not because the sky is falling. What he's really trying to point out here is that fear is a counterproductive emotion. It doesn't get you anywhere, and if anything, it causes harm. So to deal with fear, you need a strategy, an investment strategy that you have confidence in, because if you have high confidence, when the difficult times come, you know what you're going to do. It's not like you're going to lose sleep overnight and so forth. Anyway, great money manager, great book, by the way, called One Up on Wall Street. Let's get into the market here. Here's the NASDAQ. As you know, we've kind of gone to what we call the early tides. Tides come in, tides go out. Well, the tides look like they were going out here. However, we consolidated, rested a little bit, just like after a big Thanksgiving meal. Sometimes you go on the couch and rest for a little while. Anyway, so it's breaking out. So NASDAQ is looking somewhat positive. Same here for the mid-caps. Mid-cap stocks, the middle-sized companies, have held up pretty well above the 10-day moving average. Everything is in an uptrend. Looks like the bull market is resuming here. New York Stock Exchange Composite, every stock on the New York Stock Exchange. Very nice uptrend, no problem there. Then we have the small caps, which is, the smaller companies. They were really looking good here for a good while. In fact, they were outperforming dramatically. Then we got the pullback, the correction. Now we're getting the consolidation, but it is holding above the 10-day. Uptrend continues to be up. Here's the S&P large cap. Now, this is what's really amazing here. This is one that we were quite concerned about as an index, but it's actually outperforming, hitting new highs. So the S&P looks great. You know what they say? They said when the generals lead, the troops will follow. All right. Now, we go into the NASDAQ on a weekly basis, which is an important indicator, has been really one of the better indicators that I use. Very simple, nothing to it. 35-week moving average. You look for 2 consecutive down weeks below the moving average. We're not getting there. You can see we kind of got close, but we never broke it. So that's interesting. Now, here we have the aggression index, which we're going to talk a little bit about. This is a very important indicator. Now, on a daily basis, I use the 50-day moving average, and you can see we decisively broke below that. So what it means is that some of the steam of the optimism is being let out. But you can see here that, it did pull back quite a bit. So let's look at the actual indicator. The actual indicator, and you really don't want to underestimate it because I'm going to show you something here in a minute. What we're using here primarily is the 40-week moving average. We want the ratio to stay above that moving average. We don't want to see a total collapse in optimism. So if we go back over time, what I did is I went back 20 years and I took the aggression index, and we're using only the indicator, which is the 40-week moving average. And you can see here that since the last 20 years, this particular indicator is only given a sell signal 3 times. Now, we got very close to a sell signal here recently, but we didn't break. So the main thing is this. We're starting to see where the market is getting kind of at a transition point where we need to hold in here and we need to rally. But at the same time, we are not getting sell signals. So you'd have to trade the chart in front of you. Now, here is interest rates. You're seeing interest rates backing off a little bit. Oil kind of backing off. You'll see that we have in the top 5 quite a few oil stocks, which continues to be interesting because I hear if we hang around the $60 level, these companies really do go cash flow positive, and it's good news. Financial stocks are holding up. We want the financials to hold up. Now, on new lows, we're getting on the New York Stock Exchange, we're kind of seeing a settling down there. Now, also, I went and looked at another indicator called, with the NASDAQ, new low percent total. So you can see here back around March 23rd with the pandemic scare, and we've gotten down to really a very low number here as new lows on the NASDAQ. So this looks constructive. Put-call ratio, we continue to be in somewhat high optimism, however, somewhat improving. We're keeping an eye on it. Volatility index actually hitting a new low. This is very good news. This is another reason I believe maybe the bull market is resuming. We're getting down below 20. We're starting to settle down, and the market is definitely in an uptrend. So if we get low volatility, steady uptrend, things will continue to do well. Now, this kind of talks about this, and I want to mention this article by a Bernstein analyst who is basically looking at fiscal and monetary policy, and he's saying the stock market could double by 2030 because COVID has utterly changed the policy environment. This is a Bernstein analyst. He's saying that he thinks the S&P 500 decade-end target to 8,000. That would be very nice. So let's kind of look at maybe some reasons I think this could happen. You know, it boils down to human behavior, because if we go back to 1980 on this graph, and this is the S&P 500, around the time, Ronald Reagan was president, we went into a very powerful uptrend that starting in 1995, actually, you can see here the trend, but the trend accelerated between 95 and 2000. So what human behavior basically is, and by the way, I've got the 200-week moving average here to kind of give you a guide to see how steady that uptrend was. Now, we did have the crash of 87 in here, which scared everybody to death, but we got through it and got back into an uptrend again. We will have things like that happen. But anyway, you got 16 years of an uptrend. Then we went sideways for 16 years. This was a very difficult period. Bear market number one. Everybody's starting to get confident again. Bear market number two. You really don't see that many bear markets in many generations. So the point is, we have an entire generation of investors that are exhausted with the stock market. Now we start to resume the uptrend again. So the question is our friend right that the S&P is going to double by the end of the decade? Now, also, I thought this would be another reason that I think this could happen is I've got a ratio here of stocks, excuse me. Excuse me, I have a ratio here of stocks to treasury bonds, and I've shown graphs like this almost every week. The point is that as that line goes up, it says that stocks are doing better than bonds. So there's a tremendous amount of capital because of all that fear that was built up over that 16-year period that we talked about. A lot of that money all went into bond funds. And so if bonds start underperforming, which they're doing, on a consistent basis, at some time that money's going to flow to the stock market. That's what we think, at least. It's just our opinion. Now, the top five, as I said, we're going to see some energy stocks here. Here's Cimarex Energy. Most of these companies are producing out of the Permian Basin in West Texas. Alcoa, aluminum. You kind of seeing with oil, metals, it's kind of an inflationary thing, that you start thinking maybe these companies that produce the inputs, such as semiconductors or steel or aluminum or copper, these companies' prices are going up, and as a result, that could be squeezing profit margins on some manufacturers. Just be aware of that. Cleveland Cliffs, this is steel. Here we have Callon Petroleum, which is actually out of Mississippi at one time. Looking okay, breaking down below the 10-day, but I'm saying that, again, we're seeing a lot of energy names. Now, here's TripAdvisor, which is a travel stock. However, looking okay. Now, these things make the top five because they have been strong for a certain period of time. So what I'm doing is I'm taking an 8,000 stock database, and then I'm boiling it down to about 60 or 70, and then I'll take the top five of those on just a pure momentum basis, just so that we can see where the money seems to be flowing over a period. Anyway, if you have any questions, please give me a call. Thank you very much.